First question I got to ask, did you sell any shares of Uber today?
No, I did not.
Do you plan on selling them going forward?
With any sort of early venture capital investment, there's always a distribution schedule. There's always a diversification schedule after going public. And that's pretty normal for all investors. And so, I think myself and other investors will constantly do that over time. But I think this would be not a good time to do that. I think that the stock is undervalued. I think the company went public in an environment where there was a lot of macro issues, as well as a lot of an argument between private tech markets, investor markets, and public tech investor markets. So I think that the valuation argument is still playing out. And on the other side, just looking at the company itself, it's going through a rite of passage, which is once you go public, there's sort of a fitness on what the market wants in terms of metrics to understand the business and model it out and really get into the details. And there's also a lockup expiration. And all these things are sort of normal things that happen to public companies like Facebook or Twitter. And you're seeing that play out now.
Why do you think there is such a disconnect between what private investors were willing to hear in terms of the information, the metrics, et cetera, and what the public market investors wanted? Why was there such a gap?
I think that in the private markets, we had an influx of venture capital coming from a lot of late stage or even some public institutional capital. And so, I think in that mindset, there was an idea that you could do sort of a pseudo IPO at these late stages. And I think valuations were, admittedly, the entire market was very optimistic and aggressive about it. And I think the macro climate changed this year, especially this summer, with a lot of the tariff wars and all companies across tech sort of getting hit. And I think there's also been a public opinion sway about really scrutinizing what are these public tech companies. And so in the midst of all of the social, political, and economic upheaval in the markets, private valuations from last year or even the year before that, compared to public market valuations this year, there's a disconnect. And so I think that's going to get played out, and that's going to normalize like it always does in the markets. And I think Uber is going to be a company to watch there, and Dara and Nelson are doing the right thing. And I think in this last earnings call, they showed more metrics so that each business unit could be understood. They're showing 30% year-over-year growth. The company is growing in a healthy way. They're the market leader in ride sharing and delivery, and making the most comprehensive investment in new technologies, such as Uber Elevate, Uber Freight, Uber Health. And they have the largest international expanse in terms of market share. They have significant ownership in Didi, in Yandex, Careem, and Grab in Southeast Asia. So they're the largest global network in ride sharing and delivery by equity assets, as well as revenue, as well as customer base. So I'm holding for the long term, and that's why I'm excited.
Very quick question, if I might. Has what's happened to some of these former unicorns, is it going to change the appetite for these companies to go public? Why would they do it if they hit a banana peel when they do?
I think it's hard to predict what the overall larger market, global market, will be doing when you start a process to go public. We at Kedra Ventures, we invest so early as the very first institutional fund money in startups at day zero. A lot of these things play out over 8 to even 15 years. And so when you're ready, you're ready. When you need to go public because of shareholder frameworks and the capital needed and the ability to create liquidity for your investors, you should be able to be in the fitness as a company to go public regardless of those markets. I mean, there's some edge cases. And so I think it just puts the bar higher in preparation. I think the lessons learned might be, figure out what the metrics are that the market wants in the public markets before going public.
Right.
I think some of the other things too might be look at direct listings in situations where you may not need a large sum of capital upfront. Now, Uber did the right thing in doing an IPO because now they have $12.7 billion in cash and cash equivalents. So in terms of a war chest, they're also sort of the leader there globally to be able to do that. And so I think a lot of new factors from this year are going into the thought process in an IPO.
All right, Steve, thank you very much. I love that blue bottle of coffee. I had one across the street from where you're sitting the day before yesterday.
One of our best portfolio investments, yeah.
Oh, boy, it's good coffee, Steve. Jang.